Good morning. Good morning. I am Dr. Charlene here to talk to you on Ask the Expert. I love this show because we select each guest speaker based on their profession and their expertise and bring the information to you so that you can make a difference in your life. Each one of these members comes from the Authors and Speakers Visibility Playground, and they are selected to bring their information to you. So I love the people that I have on this show, and we come to you every Friday at 9 a.m. Pacific time. And today's going to be a great show. Please don't forget to like us down below or click subscribe if you happen to be on YouTube. Now, today we're going to talk about Naked Tax Talk. We're going to actually bear it all and tell you how you can save money you didn't know you can save. And one of the most important things, if you wish to get your business out of the hobby zone and into a real business, is to select an accountant that understands the write-offs for everyone's business. This is so important. And the thing is that you have to interview each accountant to see what they are willing to do. And the steps for interviewing the accountants are on my 4-time award-winning Selling Through Your Heart book. So you can get the book and look at the steps for interviewing the right accountant. So many times I'm talking to my clients and they say, oh, my accountant says I can't do that. Well, that's not true. It's just that they don't know you can do that. And unless you interview them, you're going to leave a lot of money laying on the table that could be in your pocket. And the man we're going to talk to today is going to tell you how you can save $20,000 in taxes. And if you already have an accountant and you aren't saving the money you need to save, listen in here because this will change your life, I promise. Welcome back, and thank you so much for spending time with us this morning. And I want to get going right away because I don't want to waste any time. This is so important to our business. It's important because we want to stay in business and we can't afford to pay taxes that we really shouldn't be paying. And why do we have a business anyway? It's so that we can have our independence and have our write-offs. Now, our guest today is amazing. He has a bachelor's in business accounting, and he even has a master's in secondary education. He was a teacher forever, and all of his students absolutely adored him. And I know that you'll adore him too. Let's welcome Jonathan Bengel. He goes by JB to our set so that he can talk to you about Naked Tax Talk. Welcome, JB. I'm so glad you're here with me this morning. I want you to get down to the bare bones, will you?
Yeah, well, good morning to you, Dr. Charlene. Thank you so much for having me as a guest.
You are certainly welcome. I'm honored.
Yes, thank you. Well, likewise, it's very mutual. Yeah, so exactly as you said it. So would you believe me? Well, I know you would, but maybe others wouldn't, but they might. If I told you that Americans continue to overpay by $1 billion a year in unnecessary taxes to a government that actually does not want their money if they're in business for themselves.
Wow, that's a shock.
Yes, absolutely. And just like you said earlier, yes, I'm Jonathan Bengel. I'm the founder of JB Financial, Naked Tax Talk, and now Naked Tax University. For the past 18 years, I've created a multi-six-figure company. I've saved jobs, and I've also saved millions of dollars for my clients year after year. I'm a IRS agent. I'm a IRS enrolled agent. I'm a certified tax coach, certified tax planner, a fellow of the National Tax Institute, and I'm also an author for a book called The ABCs of Deductions.
Awesome.
Um, one of my
So
greatest one of my
go
great
ahead.
one of my greatest claims to fame is saving a client $500,000 that was being charged to them. It was assessed. We got them off the hook and settled for exactly $0. So today, women entrepreneurs and LGBT-owned companies hire us as their elite naked tax consultants because most fear the IRS. And as a result, they do not proactively plan. And so they continue to grossly overpay and underdeduct those $1 billion I just mentioned earlier. So what we do is we help to unlock the mystery of taxation, because the truth is there's no mystery. We help to uncover legal loopholes, because that's how the rich stay rich. And we also help to share with them missed opportunities. That's money that was left on the table, and go back and get it. So bottom line, we take our clients from emotion of being sick, of anxiety, of fear, of the unknown, into stepping into their power of what is possible, which is ultimate financial freedom utilizing tax law.
So JB, thank you for all of that. I love that you do proactive tax planning. That's really awesome. So tell me something. What do you think is the biggest mistake that accountants make?
Accountants?
Mhm.
My industry, my fellow peers.
Yep. I put you on the spot. You weren't expecting it.
That's okay. That's all right. The truth of the matter is that the majority of accountants that are not proactive planners ultimately are what we call reactionary, meaning that you're dealing with them. Typical is you're dealing with them either at the end of the year, just before tax season starts, and you're giving them a box full of receipts, or you're giving them something, and they're just turning around and they're plugging it into the tax return. And they may be very well offering advice and asking you questions in order to assess the situation, but more often than not, it's already too late. And so what ends up happening is you get surprised with a larger tax bill. The accountant's doing what they can do, because this is what we've been trained to do from the time we go to university, really. And so it's always very reactionary. It's never in the forefront. So another thing that my peers could do better is be in the forefront of telling our clients, this is what's happening, this is how the law is changing, and this is how it's going to impact you on an individual basis. And like right now, take with the CARES Act, right? We're going through a pandemic. The CARES Act created, believe it or not, a massive tax burden on the taxpayer, especially if you're in business for yourself. So we all heard about the PPP and the EIDL, and we all got hot and bothered and horny over it, and we went out and we applied and we got the money. All right. So that's fantastic. Like we're all jizzing all over the place. We're super excited about it. But here's the problem. Someone's got to clean up that mess. And who's going to clean it up? Uncle Sam. So what they did not tell you, see, they're like the people that like to play with you, but don't actually want to tell you everything behind their hidden agenda. So what they did is they gave out all this money, which is going to create, believe it or not, taxable income. Hear me out. Taxable income to the receiver of the forgivable portion of these loans. Now, what I'm telling you is that knowledge is what a proactive tax planner takes and goes, okay, so this is going to create revenue, taxable income for my client. Now, they're not calling it that, you see, because they're trying to put blinders on you. They're not calling it revenue. They're not calling it income. They're just saying you're not allowed to deduct the expenses for which the money should be used for, which in a sense is cock blocking my net profits, making it higher, which means I'm going to pay a higher tax.
Exactly.
So needless to say, the proactive planner goes, okay, so now that we know this, we've got to find a way, we got to strategize to mitigate the damages that is happening with the forgiveness portion of the loan. So what we now have something is called a tax credit, because something else they didn't tell you about was called the retention employee tax credit, which means that for tax credits, it's a dollar for dollar reduction in your taxes versus a deduction or a write-off. It's a percentage, and not all write-offs have the same weight. So it's much like if you threw two different balls during gravity, right? The matter that has heavier dents will fall at the same time, but yet one will bounce and the other one will stay stuck to the ground. That's like deductions, right? And write-offs. So they're not weighed the same. Tax credits, on the other hand, weighted the same, dollar for dollar reduction. So now that we know we have tax credits we get to play with, now we get to go back to our clients on a proactive basis versus the accountants that are reactionary. The proactive accountant's going to go forward and say, so check this out, client. You got that PPP. We know you're going to be forgiven for X amount of dollars. But what if we run an analysis, which is what we've just done recently for some of our clients? What if we run an analysis and determine which is the better option, the tax credit or the forgiveness portion of the loan? And what we're actually finding right now in our analysis is that it's actually a better option to take the tax credits than it is to take the forgiveness portion of the loan. Now, I'll say this, that my lawyers have advised me that anything I say on this program or any program that I get on should not be taken as mere advice, for advice must be actually contractually agreed upon and written out. So anything I say you and hear, feel free to talk to another professional about it. But the truth of the matter is this is what we're finding for our clients, that it's actually better for them to take the tax credit than it is to take the forgiveness portion of the loan. Now, why is that a beautiful thing? Well, because the PPP and the EIDL are restricted to how you can use the funds, especially if you want it to be forgiven. But if you violate the rules, there are some loopholes in there that you may be able to use the funds for other things that you need that may not necessarily be related to your wages.
So that leads me to the question I wanted to ask you. First of all, would you define for everybody PPP? You're using your accountant's.
Yeah, I'm using my lingo. So the PPP is for a PPP. Yeah, even those are nasty. So it's the Paycheck Protection Program that was done by the CARES Act, and then the EIDL. You cannot take a pill to fix that, but it's it was the emergency injury disaster loan. That's it. The emergency injury disaster loan that was also created by the CARES Act as well. And then the employee retention credit was created by, I believe it was the same act, the CARES Act, or it might have been the one that just came after it. But there was two laws that were passed. So one was the CARES Act, and then like 2 or 3 weeks later, there was another one called, I think, the American Recovery something Act. And that I think is what, and here's the other thing. So why do you work with a proactive planner like myself? Well, proactive, meaning we're in advance of, right? We're in the front of it. We're already naked for you so that you don't have to get naked, right? So we're in the forefront of figuring this shit out for you so that you don't have to stress out about it, which is what my clients do. When they first came to me, they were stressed. They were full of anxiety. They couldn't get any sleep. They were exhausted. They were nervous. They were fearful. You name it. All of those things that we associate with money, they were. And now they're in the rhythm of success. That's what my friend Natalie said, rhythm of success. We're saving them over $20,000 a year in taxes. Just recently, we saved a client. Last year, we did the final analysis, $148,000 in revenue and in taxes. We saved another client $141,000 in taxes last year. So the point is you got these clients that are coming in with all of the stress, and we're taking it away. Well, how do we do that? Well, by being naked in the forefront of what's happening with these laws. So with the CARES Act, see, here's the thing again, no one shared this but with us geniuses. And that is that some of the 18 reform laws, we all remember the Tax Cut Jobs Creation Act or whatever was passed in 18, right? It was the largest tax reform since like 1986 or something like that, right? It was big, it was massive. And the idea there was to spur the economy and to put more money and things like this. Now, let me preface by saying that Uncle Sam controls our lives on an individual basis and a business level basis. This is the truth. This is what it's designed to do. And so it uses tax law as one way to create incentives, which incentivizes us either on an individual level or on a business level to take action. And so what that boils down to is just like Newton's law, for every action you take, there is a reaction. And so in this case, when it comes to income tax, for every action you take, there is a taxable event. There always is on the other end. So they incentivize us. So they might say, like, if you get married, you get double the deductions. You get double that, you double it all up. And one of you might have no money and one of you might have a lot of money, but you still get the same freaking benefit, babies, right? Or if you're married, but you separate because Uncle Sam doesn't like it, he punishes you, and now you get less deductions than if you were single. So this is on an individual basis. But on a business basis, Uncle Sam can say things like, if you retain your employees through this crisis, we will give you a tax credit, dollar for dollar reduction, on your payroll tax to retain your employees, right? Now, as a business owner, theoretically, we go, ooh la la, let me retain my employees. By the way, if I'm a shareholder of my own S corporation or C corporation, who's an employee? Right?
Exactly.
Who benefits from that? So I'm just saying. So they use incentives. So when they create laws all the time, it's incentivizing us. So in 18, as we know, the Orange Cheeto wanted to create laws of his own and his party, the cronies that we know, in order to create these laws. And so they did. They fattened the books of corporations, which totally legal. Let's understand this. There's a morality question, an ethical question, etc. But the dealio is that the same laws that they enact are not just for the wealthy. They are also for you. For you, the entrepreneur that's sitting right now watching this show, taking down notes maybe. It's designed for you. You are entitled to the same rules that the millionaires out there are, or the billionaires or quadrillionaires. You are entitled to the same opportunities. So they essentially repealed a lot of things that normally the wealthy were entitled to, attempting to, I should say. But because geniuses like us, we find the loopholes and we go, well, you did strike out this. But if you rephrase it and redocument it in this manner, now you have an opportunity to potentially deduct the whole damn thing as opposed to being limited to it. I'll give you one example. You talked about deductions. I'll give you one example. Everyone here has a medical condition of some sort, right? We all take prescriptions of some sort, I'm sure of it. We got kids that are in school, we got kids on ADHD medications. We're on medications. We're all doing something, right? We go to the doctor for an annual checkup, or we go to the doctor because we're suffering from something. But the point is that we're all paying out. So I'm going to demonstrate a deduction and a loophole at the same time. So here we go. The deduction is this. When you normally go to the doctor, you experience out of your pocket, you pay a premium. So let's say you pay $1,000 to go see the doctor for a specialist. We're allowed to, as an individual, to deduct the $1,000 as a medical related expense, subjected to what we call a haircut, which today is 7.5%, which means a whole bunch of complicated, convoluted bull. But what I can share with you is that sorry, Dr. Shirlene, you kind of when you took yourself out.
Well, you were the star, so I thought I'd leave you there on your own for
No, that's okay. It's because I know I'm talking to you and I'm also talking to the audience. So you're allowed to deduct, right, this medical cost, and it's subjected to, like I said, a 7.5% haircut. And there's a lot of rules around this. It's really complex. But most taxpayers do not even benefit from that, meaning they don't even get to actually deduct that from their income. And so they end up paying taxes. Now, there's a loophole, which is that normally businesses are not allowed to deduct medical costs. All right. This is normal, except that there's a loophole in the law that allows us to implement, if we implement the right strategy, all right, open up the right loophole, we can convert a personal medical expense that's normally going to be limited and shift it. By the way, as a tax planner, this is what we do: income shifting, expense shifting, investment shifting, entity shifting. This is what we do. So they shift the money from the personal level into the business. Now, this is done through what we call Section 105. It's a part of the law under Title 26, and it's called Section 105. And Section 105 says that if I set up a plan to account for the medical costs, we are allowed to now deduct it as an expense against the company. So now all of a sudden I get to offer the same benefit to my employees. I get to offer the same benefit to the people I hire, like my employees that are working over here on the other side. I can pay for my healthcare premiums, my dental insurance premiums, vision and premiums, disability and premiums, long-term disability, short-term disability, doctor visits, co-payments, prescribed medications, and women's menstrual products, by the way, now qualify as a medical expense. So if you're a woman-owned company, now all of a sudden you might be able to consider this as an option. And just saying. So the point about
Okay, I have
this is
question. What about life insurance? Can you write that off?
under certain circumstances, in this case, it does not qualify for this.
Okay. So would you
So
address that when you're done?
yes, remind me
Okay.
too if I forget it. So
Okay.
yes. So medical, so everything as medical is now going to go under what we call a medical expense reimbursement plan. And its guidance comes from section 105 of the law. And so again, there's no mystery here. Go look it up yourselves if you'd like, or you can hire someone like me who understands it already and quite honestly can help you to strategize how to shift that into your business. Because I will say everything I say always comes with a limitations do apply, because that is the truth. I will say here and say all these great things, but please know that limitations do apply. And the reason for that is because there's things that jack it all up, like our entity. So if you're a sole proprietor, you can sort of get away with it. There are strategies, by the way, and we do this with our clients. If you are an S corporation, again, another strategy, because what happens with the S corp in particular, if I provide that benefit to me, the employee, and the shareholder, and I own more than 2%, which I do, then I actually have to turn around and report that back as income on my W-2.
Mhm.
But here's the beautiful thing, babies. I'm essentially mitigating a mandatory tax on my wages, which is called FICA tax, Social Security and Medicare. And that's a mandatory tax of 7.65% on the employer side and 7.65% on the employee's side. But who's ultimately having to pay for the whole kit and caboodle, right? My company is ultimately, because I'm also the employee of my own company. So I'm ultimately, the cash is coming out of the same pocket. Let's be real here, right? So this loophole keeps 15.3% of my money in my pocketbook that's going to then go and pay for my medical related expenses, which then is going to reduce my taxable income more, which means I'm going to pay less taxes, even if I have to report the difference, some of it on my W-2 as income subjected to ordinary tax. So this is how we can take clients that are making $150,000 a year on average and saving them over $20,000 on average in taxes. This is one of our strategies. But notice, it's a deduction and a strategy go hand in hand. And then we also turn around and we go, well, that's fantastic for year one, but what about year 2, 3, 4, 5, and onward? So now what we do is we look at the law and we go, okay, well, here's how it's currently written. Let's keep it going. So this is why we charge a client when they come work with us. They're on a maintenance program, because what happens is, just now with the CARES Act, when it got passed, it changed a whole bunch of rules under the tax law that were very subtle, that were things that were repealed originally that are now back into the game of opportunities. You see, proactive tax accountants like myself, we don't look at the losses, we look at opportunities. As business owners, we're always looking for opportunities. So my job is to find the opportunities inside the tax law. So one of them, another one, are you ready? Called the net operating loss, NOLs. You hear this all the time. You hear this thrown out there by their accountants, or you hear it, you've heard it. You know you've heard it, an NOL. You're like, what the hell is that? Net operating loss. Now, pre-18, net operating losses were important because when you started up a company, you experienced losses. This is typical of most companies that start up.
Mhm.
And Uncle Sam fundamentally understands this. And so he wants to keep you in business. So he says to you, taxpayer, you are mandated to go backwards in time 2 years to carry that loss backwards. By the way, if I'm doing that, I'm entitled to something called an amendment to my tax return, which frees up taxes I paid, which means more money in my pocket. Huh, interesting. So then I can carry it forward into future years once I extinguish, if I have not extinguished it by going backwards, because only in taxes can I go back in time. See, so I go backwards, and if it's not extinguished, I go forward until it's extinguished. Typically, it's anywhere between 5 to 20 years or lifetimes, depending on the type of net OLs. Limitations do apply. So the thing is that you've had this NOL, right? In the 18 reform law, that was repealed. They said, nope, you can't do that. You can't go backwards anymore and claim what you needed. You can't do that. That's a no-no now, right? The CARES Act snuck in and repealed the repeal of that provision, which now opens up the losses again. So right now, majority of taxpayers, entrepreneurs may experience some hardship, and we probably all are. I mean, we all are. Let's be real here. And the truth of the matter is that because we're experiencing this hardship, we're going to need to go backwards in time. Now we're allowed to, and look at amending our returns going backwards and freeing up cash.
Beautiful. That's beautiful. But you still didn't invest. You didn't say anything about the life insurance.
Life insurance is typically non-deductible. It's not necessarily a write-off. It's not necessarily an expense. And the reason for that is because life insurance is a beautiful instrument. Beautiful instrument. Actually, insurance in general is a beautiful instrument because insurance is extremely protected. It's extremely protected. You can blame it on the lobbyists since the time the country was founded, but they understand what the hell insurance really means. And so because of that, life insurance in particular, the deductions, the premiums are non-deductible. Now, why is that? Well, if someone deducts something on their tax return, there is income typically that's reported to somebody else. Someone has to pick up the tab, babies. Remember, for every action, there's a reaction, right? But life insurance is different. Life insurance says you can't deduct the premiums, but when you die, we're going to pay out the life benefits, whatever they are, right? 100,000, 500,000, 1 million, 2 million, 1 trillion, whatever. And your beneficiaries are going to receive this money tax-free, right? Tax-free. So that's important, right? Because if they allowed us to deduct the insurance premiums for life insurance, the life insurance policy would theoretically be taxable income to you, but nobody wants that. Let's be real here, right? And typically people of the upper middle class or the super wealthy spend a lot of money on life insurance policies because they understand this. Now, there's a loophole for that. So the loophole, all right, are you ready for this?
You better be quick. We only have a few minutes left.
The loophole for this is with the right structure, the right entity, and the right beneficiary. In some circumstances, the life insurance policies, the premiums can be deductible, but it's extremely rare, extremely difficult, and only under certain circumstances. Now, if you have at least $250,000 in cash laying around, because you have nothing else to do with it, because you're what I would call cash saturated, and you just have 250 G's every year laying around, you don't know what to do with it, right? What you can do is actually set up your own insurance company. Interesting.
Yes.
And so now your company has a deduction on the books, and the income's not reported to the government. Now that's a double win, don't you think?
Yeah, that's definitely a double win.
So
wow.
people can actually create their own insurance companies. Typically, you're looking at doctors, maybe some lawyers, maybe some accountants, high wealth individuals. And what's beautiful about that, like I said, is it's a win-win. One gets deduct, no income reported. Now, I will tell you it's highly scrutinized, it's highly audited, and tax court is trying to win cases because the benefit is massive. Not majority of us, many of us taxpayers will never necessarily go into that necessarily, but wouldn't that be amazing? However, I can use life insurance and create something called, I believe, an IUL or something like this. I'm not an insurance rep, so I don't know. I'm not here to sell insurance, okay? But what we can do is when a client is cash saturated and they're looking for the ultimate tax-free life, besides using Roths, all right, which is what people use, besides using Roths, we can use life insurance, believe it or not. And what we do, correct me if I'm wrong here, are you life insurance agents out there? Correct me if I'm wrong. But what we do is we say, you know what, we're going to take a life insurance policy out. It could be on myself or a spouse or my children or something. And let's say we take $1 million policy out. And so what we do is we front load the policy. So the premiums, let's say it's $100 a month. But I'm going to front load it and I'm going to pay $1,000 a month. And I'm just going to just keep chunking money in it. Boom, 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 boom.
There's only so much.
Okay, there you go. See?
Whatever the base amount is.
Limitations do apply. So, so just remember that, right? Limitations do apply. But in general, how's that? In general, the idea, the theory is that you're going to prepay all these premiums in advance to essentially pay out the premiums faster. And then what happens is the residual starts to earn earnings, right?
And you never lose your money, even if the market goes down, and no one can sue you for that money either.
Yes, it's ultimately protected. And then when you're old and gray and you've decided you're done, you can actually borrow. Now, this is freaking fascinating. So again, you have $1 million policy, you can borrow, let's say up to $500,000. You can borrow and you get the money and you use it for what you got to use it for. And you don't have to pay it back because it's your own insurance policy, right? You don't have to pay it back.
You have to pay back.
Limitations do apply, right? And so then theoretically what happens is let's say you die. All right. And you still have this big insurance. Well, what happens is that the insurance policy will pay off the loan balance first and distribute the rest to your heirs. So they still get the cash. You still benefited from it. And it was ultimately a tax-free life.
Yes, absolutely. And I have to stop you there because we've already run over. This has been fascinating. Absolutely fascinating, JB. And I am so glad that you came on the show to share this, because I think that people need to get tax savvy. And they also have to think about that SEP IRA. I'm going to be talking about that on Let's Get Real this afternoon at 1 p.m. Pacific time. I'm going to talk about what's going on with regard to your 401k or your SEP IRA, because this combination with JB is a heavy hitter that will save you a ton of money. JB, thanks so much for being with us today. I'm sorry, I have to run. I'm already over.
All good.
over. And I am so grateful that you are in the Authors and Speakers Visibility Playground, because all of these people are heavy hitters and they need you.
Absolutely. And real fast, real quick, you asked for a free gift. So I think you had it scrolling earlier. If they text the word "Let's Get Naked," all one word, no apostrophes, nothing, just "Let's Get Naked" to 555-888. You will meet Censor, who will greet you and take you to my spa, and you will find out what kind of tax personality you are. And then after that, you're going to receive an actual Excel sheet that many taxpayers can benefit from that will help them to organize their business expenses on a monthly basis, which then will auto tally it at the end of the year, and you can present that to your tax preparer.
One last question. If we meet with you, do we have to be naked?
No.
Thanks a lot, my friend. Thanks for being with me. Well, everyone, again, I told you that was going to be an awesome segment and that you would really learn some things that'll make a difference in your pocket. What you want to do as a business owner is everything that you can to keep the money in your pocket, because there's a lot of money that goes out to run our businesses, right? So if you didn't catch all of it, and you probably didn't, go back and review this once again and take some notes. And if you don't have an accountant or you haven't taken the time to interview accountants, get my book, Selling Through Your Heart. It was a #1 bestseller in 4 countries. And also it's won 4 awards. So you can't go wrong with getting that book, Selling Through Your Heart. And if you don't have an accountant, meet up with JB. Do that text, go through the little bit of process that he has, and then move forward with saving money and keeping it in your pocket. Bye-bye. See you next Friday with another juicy, juicy show. And I hope you loved this one. Put it into practice, though. It doesn't do any good if you learn something and you don't put it into practice.